Today we're focusing on, well, one chart that has just completely taken over the commodities world this year.
It's all anyone is talking about.
It really is. It's the iShares Silver Trust, ticker SLV. And we've managed to get our hands on a really deep dive analysis report that tries to answer the one question everyone is asking about silver right now.
The big anxious question.
Exactly. I mean, look at the numbers. SLV has posted just an astonishing 141% return year to date.
141%. It's hard to even get your head around that.
It is. It's blown past every single historical high. And as we're talking, it's sitting at $65.22. Just a stunning, stunning run.
And that's where the fear comes in, right?
Absolutely. The second you see a chart that's gone completely vertical like that, the immediate, overwhelming thought is, am I too late?
Has the train already left the station?
Right. Is the easy money gone? And the whole mission of this analysis report we're looking at was to tackle that fear head on.
And it does, with absolutely zero hesitation. I mean, the report's main conclusion is it's aggressive, it's confident, and really, really contrarian.
So what's the bottom line?
The bottom line is that they assert this current price, $65, is not some kind of temporary ceiling before a crash.
Okay.
They believe, and they argue this very firmly, that this level is actually the new floor.
The new floor. Wow. Okay.
Yeah. So today we're going to unpack the three powerful, sort of interconnected arguments they use to back up this very bullish view. They call it a historic blue sky breakout.
A blue sky breakout. I like that.
And their claim is that the 141% move we've already seen, well, that was just the warm-up.
Okay, let's get into this then. We have to start with the psychology because the market, it loves to think in terms of averages and reversion.
Mm-hmm.
When a chart goes vertical, the knee-jerk reaction for almost every individual investor is to back away. They're convinced it has to revert to the mean any minute. It just feels dangerous.
And that's a real psychological hurdle. The report actually targets that specific feeling of an asset being overbought.
So how do they counter that?
Their whole contrarian view is really rooted in this idea of a commodity supercycle.
A supercycle. Okay, so what's the distinction?
Well, if this were just a normal bull market, then yes, you'd absolutely expect a big pullback after a run like this. But when an asset enters a true supercycle, which historically, these things are driven by huge structural shifts in supply and demand and, monetary policy.
Macro forces.
Exactly. In that environment, assets don't just revert. They consolidate for a bit and then they extend their gains, often way beyond what conventional technicals would suggest. So this initial spike, it's momentum building, not exhaustion.
That is a crucial distinction. So the argument is we need to stop looking at this as an unsustainable spike and start seeing it as like a structural repricing.
That's the core idea.
Okay, but what concrete evidence does the analysis offer to back that up? The supercycle narrative over just a classic bubble narrative.
So the evidence they point to is all about who is doing the buying. They highlight this dramatic, sustained increase in trading volume.
The volume, right.
Yeah, sometimes getting close to 60 million shares a day in SLV. That kind of consistent, heavy volume, especially after a huge breakout like this, is the classic hallmark of institutional accumulation.
So the smart money.
That's what it suggests. It implies the big funds are just now starting to build their positions. They see $65 as an entry point, not an exit.
That's a powerful point.
And on top of that, they put silver's price into context by looking at the gold-silver ratio.
Okay, and for anyone who doesn't know, that ratio just tells us how many ounces of silver it takes to buy 1 ounce of gold.
Exactly. And historically, over the last 50 years, that ratio has often been around, say, 55 to 1 or 60 to 1.
And where is it now?
Well, the analysis notes that even with silver at $65, the ratio is still historically really high, much closer to 85 to 1, sometimes even higher.
So wait, if the ratio now is 85 to 1, but the historical average is closer to 55 to 1,
it means silver still has a lot of ground to cover just to catch up to where gold is right now.
So it's not actually expensive yet. It's just underpriced compared to its sister metal.
Exactly. It completely reframes the conversation. You stop thinking, wow, it's up 141%, and you start thinking, wow, it's finally starting to catch up.
And from a technical standpoint,
yeah,
that must also confirm the importance of breaking that old resistance at $50.
Oh, absolutely. The report is very clear on this. Breaking that key technical ceiling fundamentally changes the market's structure. The $50 level, which was a lid on silver for years, it's now cemented as a new, solid support, a foundation for the next climb.
So the technical and psychological walls have been broken. But, charts just tell the story. They don't create it. This analysis isn't just based on momentum, is it? It argues the price has to go higher because of fundamentals.
Correct. This is where the thesis gets its real substance. They argue it's a perfect storm of industrial demand, monetary policy, and some unique market structure dynamics.
So let's talk about these. What are the three foundational catalysts?
Okay, so the first catalyst they identify is the solar boom.
Right, solar panels.
Yes. Silver is an absolutely irreplaceable component in photovoltaic cells, and the report highlights that 2025 saw record-breaking, accelerating solar panel production all over the world. This is driven by, climate mandates, energy independence goals.
That's industrial demand. It's different from speculative demand because industry can't just wait for a price dip. They have to buy.
They have to buy. But the report makes an extremely strong claim here, maybe even hyperbolic.
What's the claim?
The strongest sentence in the entire analysis is this, they say. There is physically not enough silver on planet Earth to meet 2026 production goals.
Wow, okay, that sounds like a headline. But what's the mechanism there? Are they talking about mines running dry, or is it more of a logistics issue?
It's a combination of both. Mining output is constrained, yes. But the critical point is that the capacity to refine, process, and then deliver the high-purity physical silver that these industrial solar manufacturers need, it just can't keep up with the exponential demand growth.
So it's a bottleneck.
A systemic scarcity, which means demand is not very elastic. The solar companies must have the silver, almost regardless of the price. That creates a constant industrial buying pressure that sets a very, very high floor under the price.
Okay, that's catalyst one. A physical industrial supply squeeze.
Yeah.
Super compelling. What about the second point? The macro environment.
Catalyst 2 is what they call the inevitable Fed pivot.
The Federal Reserve.
Right. The analysis is built on the expectation that the U.S. Federal Reserve is going to start cutting interest rates, and they project this to start around January of 2026.
And rate cuts are generally good for hard assets.
They're great for them. And it's not just about the headline rate, it's about real interest rates. When the Fed cuts, it lowers the opportunity cost of holding something that doesn't pay a yield, like silver or gold.
So why hold a bond paying 3% if inflation is 4%?
Exactly. Your real return is negative. As those real rates go lower and lower, the appeal of hard assets as a store of value, as an inflation hedge, it just skyrockets. This monetary shift pushes huge pools of capital out of fixed income and into commodities. That puts enormous upward pressure on silver, completely separate from the industrial demand.
So you have industrial buyers fighting over physical supply, and at the same time, the whole monetary environment is shifting to make silver an irresistible financial asset.
It's a powerful 1-2 punch.
Those two forces alone paint a very bullish picture. So what's the third element that's driving this thing even higher?
The third factor is really unique to the market structure itself. It's the short squeeze dynamic.
The short squeeze, okay.
The report argues that large commercial short sellers are, and these are their words, effectively trapped above the $65 level.
And who are these commercial shorts? Are we talking about hedge funds just speculating?
Not always. Often they can be miners or refiners who are just hedging their future production. They sell contracts forward to lock in a price.
Sure, that makes sense.
But when the price moves 141% against you, those hedges become toxic. And yeah, speculators get caught too. So as the price stays strong above 65, these institutions start getting massive margin calls. They're under pressure.
And eventually they have to cover their positions.
They will be forced to cover. And forced covering means they have to go into the market and buy back SLV shares or silver contracts to close out those losing bets.
And that's not optional buying.
It's not optional. It isn't based on price analysis. It's buying based on a requirement to survive financially. That non-negotiable buying pressure provides a guaranteed tailwind, a sort of accelerant pushing the price towards the next big milestones like $70 and beyond. It becomes a self-reinforcing upward spiral.
That synergy is fascinating. You've got the industrial demand setting the floor, the Fed pivot bringing in the big financial capital, and then the short sellers acting as rocket fuel.
A perfect storm, like I said.
So with the fundamentals laid out, let's talk about the action plan. We're in uncharted territory now, with the report called blue sky territory.
That's the technical term, yeah. When an asset hits a new all-time high, it enters price discovery. And what's so fascinating is that the analysis just flat out states there is no resistance.
Because no one's ever sold at $65 before.
Exactly. The path is, at least in theory, clear.
But without that ceiling, defining the floor becomes even more important.
Paramount. And the report identifies two critical support levels for traders to watch. The first is a recent intraday low, which was around $63.60.
Okay.
But more importantly, there's the big psychological level of $60. A strong close above 60 confirms the breakout is real and that institutions are stepping in to defend this new floor.
And what about immediate targets? Just based on the chart patterns, where does the analysis predict SLV is headed in the very near future?
So the technical setup they identify is a classic bull flag pattern. That's a period of consolidation after a huge vertical run, and it's often followed by another move higher of similar size.
A mirror image move.
Pretty much. And analyzing this specific formation, their calculated technical target is $72 in the short term. That's the first stop on this journey into price discovery.
So the report didn't just give the analysis, it actually laid out a specific, actionable strategy for anyone thinking about participating right now.
It did, yeah. It offers a couple of options depending on your risk appetite.
What's the aggressive plan?
The aggressive plan is simple. Buy immediately at the market price. The logic is that when you're in a supercycle breakout, if you wait for a deep dip, you might just miss the boat entirely.
And for someone a bit more conservative?
For the more conservative approach, they recommend setting limit orders down around $64. You're trying to catch any of those minor intraday dips or a bit of volatility to get a slightly better entry point.
And with any high momentum trade, risk management is absolutely essential. What did the report say would invalidate this whole bullish thesis? Where's the emergency exit?
Right, the stop loss. They define the level that signals a real trend change as a close below $58.
58?
Yeah. If SLV can't hold 60 and then closes decisively below 58, the report says you get out immediately. That would mean the breakout structure has failed, the supercycle theory is probably wrong, and a much deeper correction is likely.
Okay, let's bring all this together then. We started with the big question. Is it too late to buy SLV after it's already up 141%? We've gone through the argument that debunks the overbought myth. We've detailed the fundamental pressures from the solar scarcity and the coming Fed pivot, and we've identified the technical roadmap that's targeting $72.
And the overall verdict of the analysis is that no, it is far from too late. That 141% gain, in their view, was just the market reawakening an asset that's been sleeping for decades. They believe the main event is only starting now.
The main event. So we have the short-term target of $72. What is the final long-term prediction that the authors are staking their reputation on here?
Their specific long-term target is $75 by the end of the first quarter of 2026.
75 by the end of Q1.
Yes, and they state very clearly that they view any and all dips as buying opportunities, and that they plan to hold the asset until it eventually reaches triple digits.
Triple digits. That is a bold prediction, all rooted in this idea that industrial demand has fundamentally changed the game, with a huge monetary tailwind right behind it.
It's certainly a strong thesis, and since that report relied so heavily on the gold-silver ratio as a key piece of evidence, pointing out how cheap silver still looks compared to gold's 2025 run, it leaves us with a final provocative thought for you to think about. If that ratio were to truly normalize to go all the way back to its 50-year average of, say, 55-1, given where gold is currently trading, what would the implied price target for silver actually be, if you just do the math? And beyond the Fed and solar panels, what other global economic shifts would need to happen to make that ratio snap back to its historical average? It really makes you wonder just how high the roof on this thing truly is.